Okay, we're sitting down with Tim Norris, president of National Real Estate Insurance Group. Tim, thanks for taking time out of your busy day to meet with us and talk to some of the real estate investors about insurance.
No problem, Ben. Good to do it. Happy to do it.
Yeah, great. So we've talked a little bit about that I already use your product, and I just wanted to maybe take a few minutes to talk through some of the typical questions and concerns that a real estate investor would have with insurance.
Sure.
One of the things, I get a policy. To me, it's tough to read all the details and all the coverages and everything. Really, what should real estate investors be worried about as far as from a coverage perspective?
I think in reality, every real estate investor has kind of an easy answer, right? It's different. They're going to have different attitudes against things like self-insurance, how much appetite they have for risk, those types of things. And my attitude is really, the more you can self-insure in whatever way, shape, or form you can, the better. Because the insurance companies are, guess what? They're in the business to make money, right?
So when you say self-insure, tell me exactly what that means.
It could be things such as deductibles, because deductible inherently is a form of self-insurance.
Mm-hmm.
Obviously, the higher the deductible, the more risk you take on as the investor. But then again, the lower the cost that you pay for the insurance. Of course, you have issues to deal with, such as mortgage companies that may be involved that may not let you carry the high deductibles you want to carry. But nonetheless, the more you can self-insure, whether it be in the form of deductibles, whether it be in the form of an occupancy phase, you buy a vacant property that you're going to rehab, you paid $5,000 for it,
Mm-hmm.
and before you get to the rehab, to me, there's really not a lot of sense paying for insurance for a property that you just paid $5,000 for, and hopefully your lot's even worth more than that. Now that stated, certain things you wouldn't want to self-insure, things like liability. When it comes to that same $5,000 property that you're self-insuring from
Mm-hmm.
the property perspective, if a couple kids sneak in there with some alcohol on a Saturday night while it's vacant, you're the owner of that property. To me, that's not something I want to self-insure. So carrying that liability insurance is really not something that, or carrying the liability insurance, I should say, is something you do want to do.
Sure. So you've got two parts of a policy. You've got the liability, which is going to cover anything that may happen. Now, does that cover if somebody's in there that's a worker working with tools and those kinds of things? If somebody were to cut their hand and then all of a sudden they weren't insured properly, and
Sure.
is that the kind of coverage that it covers as well, or is that really something
No.
else that we need to be looking at as real estate investors? It's separate.
Typically, when you're dealing with insurance policies, I would try to avoid use the term covers everything you need, that type of thing.
Right.
Liability in general covers two things. It covers property damage and bodily injury to third parties with certain exclusions. One of those exclusions to which you're alluding is a workman's compensation exclusion. So if you've got an employee that really is subject to the workers' compensation law in the state in which your property is, you're going to need to carry that type of coverage. You're going to hire a third party, even if it's that handyman as we all use or used before.
Right.
Either you securing that coverage for them or making sure that they do have that coverage, to me, is paramount to making sure your business model is protected, because a worker on that property is not covered for them getting hurt in the course of their employment, course of their job, so to speak.
Sure. So really what you're saying is we want to make sure that if you're using a third party handyman, contractor, get copies of the workman comp, make sure they're insured, because guess who's going to be responsible if something happens? It's going to be you and the property that you're on. And depending on how you have your property structured, you could be putting your entire portfolio at risk if they're not separated out by LLCs or other legal means.
Sure, and then let me add to that as well. That non-insured third-party contractor, let's just say they're not hurt, but let's say they cause damage to the property that causes the property to burn down. You've got property coverage, we hope, depending on the type of insurance you carry, of course, but if they don't have any liability coverage, you have no recourse against them as that third-party contractor. You're responsible for your deductible, those types of things. So, having them not only have the workers' comp to protect themselves, as they should, but securing that general liability coverage, that contractor's liability coverage, to me is a really good move on your part. And I know it's difficult. People say, well, I got Bob, he's worked for me for years, he does great work, but he doesn't carry insurance. I'm kind of the devil's advocate in the insurance business. It's that one incident that could cause you some pretty big headaches when it comes to your business model.
Well, let's talk a little bit more about National Real Estate Insurance Group. You guys have been very successful for the last 8 to 10 years as far as focusing on this market for real estate investors and rehabbers. So what's special about your program, and why do people that are in this business, why do they really want to do business with National Real Estate Insurance Group? Can you give me the top 2 or 3 things that people are
I think probably the top thing we think is simplicity. I mean, frankly, when you have, if you're a full-time or for that matter a part-time real estate investor and you've got multiple properties, multiple phases of occupancy, sometimes owned by multiple entities, and depending on where you live, maybe even in multiple states. Well, in our program, you can aggregate all those locations on one inventory for your insurance purposes, yet we still segregate them on a cost basis so
Sure,
you can
sure.
actually account for them individually.
Yeah,
So-
actually, that's the way that I have my properties as far as all on that same policy.
Sure.
So if I'm gonna flip a property, great, I can call, it can be moved off, it's prorated, I'm
Sure.
done.
You can even, that's actually the easiest way to understand ours is everything's done on an inventory basis. So every given month, you get a copy of your inventory with the coverages relevant to the properties as they exist that given month. You simply make changes to that inventory, submit that to us. We alter the premiums and the coverages accordingly, and you just keep moving on every month. It's as simple as that.
Yeah, and I know your customer service is amazing. You know, we're not dealing with somebody that's an agent, that's just the local agent that's got an administrative person, or secretary, and somebody answer the phone. How many people you guys have in your
we have
customer
about,
service?
About 40 people on staff.
40
Yeah.
people, wow.
Yeah.
You've really grown over the last few
Yeah,
years.
exactly.
Are there some other highlights or things that you want to talk about as far as what you guys can offer real estate investors or about your insurance or your company that would be good to note?
Yeah, I think we're underwriting our program, if you will, with AM Best, A or better rated carriers. And if you want to get into the AM Best, the rating guides of these insurance companies, it's ambest.com. But A or better rated carriers gives us the ability to go to the lenders that many real estate investors utilize and show the paper that qualifies for that lender. So we're using Lloyd's of London, Scottsdale, Allianz, which was Fireman's Fund, Berkshire Hathaway, those type of companies
Sure.
out there, very, very strong.
I recognize all those
international-
names,
yeah.
but I don't
Yeah.
know a lot about the insurance business. But so then, what your point is that if you've got things that if people are doing traditional loans or whatever the lender's
That'll
going to
accommodate
say,
it.
I need to have
Certainly.
A level coverage or insurance
Certainly,
back.
replacement cost.
Yeah.
The coverage that we utilize is, if you will, it's standard coverage. We use what are called ISO-based forms. ISO is an acronym for Insurance Services Office. It's not to get into the weeds on jargon
Oh,
here.
you're getting us in the weeds.
Yeah,
here.
understood. But the point is, our coverages are no different than any other coverages out there. You have options to carry basic or special form, replacement cost, or actual cash value coverage. It's just still insurance. It's the way we aggregate and put everything together, I think, is really what sets us apart.
All right, so let's take a quick example, and we'll wrap this up and let you get back to work. If I've got a couple of duplexes, I've purchased them for a total of $85,000.
Sure.
I'm going to put $40,000 into them. So let's just say I'm at $135,000 for both pieces. If we separate them out, about $65,000 to $70,000 each.
Mm-hmm.
The street value of those are probably more like $99,000, close to $100,000.
Okay.
How should I insure that? What should I really do? And what's the approach I should take?
Yeah, I think again it gets back to how much you're willing to self-insure, what appetite for risk you have. In our program, we have a unique ability to give you what is called replacement cost coverage, which, by the way, doesn't mean that we give you enough value in a loss to be able to rebuild it. It simply means on partial loss claims, which predominantly that's what claims
Right.
are, not total losses.
Kitchen fire.
Kitchen fires.
Right.
You have the ability to recoup that, which is known as depreciation. So for any of those you have gone through a claim, you understand what that means.
Yeah, you get two checks. The first one you get,
Exactly.
and then they say once you fix it, they give you the
Exactly.
depreciation amount.
Well, we give you the ability to garner that replacement cost coverage for a minimum of $65 a square foot, meaning as long as you're insuring those properties to $65 a square foot, you get that ability to recoup that depreciation. Most carriers, I think you were alluding to get that type of coverage, you have to insure at least $100, maybe $120 a square foot. Doesn't mean, again, that we give you enough to rebuild it, which you do have the option to do. You can carry in as much coverage as you feel necessary relative to really what you want to do with the property. So to kind of go back to answering the question, I think the more you're willing to self-insure, the lower your cost is going to be. So if you say, Tim, well, you know what, they're worth $100 together, and I don't really want to be able to rebuild them as long as
There were 200 together.
200 together.
So we're at
the
about
point-
140.
So the point is, if I got enough to either buy two more, then I'm happy with that. I'm not worried about depreciation because as a real estate investor, I can garner labor and materials at less than a retail rate.
Mm-hmm.
Then my attitude would be go to at least $45 a square foot in our program, which, by the way, garners you what is known as actual cash value coverage.
Okay.
Either of those, $45 or $65 a square foot in our program, allows you to avoid that which is known as co-insurance. And again, to avoid getting into the weeds, that's a good thing. Take it for what it's worth.
Okay. Anything else you want to add to let our real estate investors know here as far as why they should do business with you?
No, I think we've focused solely on this market demographic. We, again, with 40 people on staff here in Kansas City, we're national in scope. We're dealing again with the better carriers literally across the globe, and we get what you do. I'm an investor, my partners are investors. We can not only empathize with the unique challenges that face real estate investors, we can sympathize with you.
Sure, sure. No, we appreciate that. Now, there is one thing that I seem to come up when I'm traveling, and people are like, well, my insurance carrier doesn't want to cover this area because of wind or because of, we just had a hurricane that came up the coast recently, and you guys cover in all 50 states,
Yeah, we're in all
right?
50 states, and again, in our program, Florida, everybody knows, and the coastal regions are unique animals when it comes to insurance because of those aforementioned, what are known as named storms. Well, in our program, we offer wind coverage anywhere in the country. So if you're in Miami, Florida, and you have coverage in our program, and a tornado blows through there in March, you have coverage in our program. We offer what is known as named storm coverage for additional cost, of course.
So like a rider that goes on the policy.
Exactly.
Okay.
Technically, it's a separate policy, but nonetheless, it gives you the ability to garner that. Most people, when they deal with the standard markets, they're forced, especially in Florida and those coastal areas, to either buy wind or not buy wind, one or the other. We kind of segregate it a little bit in that the named storm is what you have to buy extra. So, for instance, if you've got 15 rental houses worth 60 grand each in Orlando, with a typical carrier, you're kind of forced into either buying the wind or not buying the wind at a higher rate. With us, you can say, you know what, I've got wind with you. I'm not really worried about a hurricane blowing through and hitting my $60,000 houses here. So I'm going to forego the named storm, drive my costs down because I really don't think that's
That's a nice
number.
option.
Yeah, really good.
All right, well, hey, really appreciate your time,
problem, man.
Tim.
Good to
Always
see you as
good to see you
always.
again. Yeah, thanks.